Rome didn't build an empire on courage alone. It built it on debt. We like to imagine the Roman legions as unstoppable warriors fueled by honor and discipline, but behind every polished helmet and sharpened gladius was a supply chain of staggering complexity and cost. Thousands of men needed food, weapons, roads, and pay. Horses needed feed. Siege weapons needed timber and labor. And all of it required money. A lot of it. So how did Rome finance centuries of conquest, and why does it still matter today? Because the deeper you look into the Roman war machine, the clearer the pattern becomes. War wasn't only fought on the battlefield. It was built into the financial system itself. And once that system was in motion, it didn't come with an off switch. Let's go back. In the early Republic, Rome's military was a citizen army. If you owned land, you could be drafted. Soldiers brought their own weapons and expected to return to their farms after the campaign. But as the Republic expanded, wars became longer and farther from home. The old model started breaking down. You couldn't just grab a spear and disappear for a season anymore. You needed organized logistics, standardized equipment, and men who could stay under arms for years. That's when Rome began to centralize military financing. The state started paying stipends to soldiers. Not much, but enough to keep them in service and increasingly loyal to the system that paid them. Then came the real pivot. Conquest became a revenue model. Every new province meant new taxes, new slaves, new mines, new tribute. Victory didn't just expand the map, it expanded the tax base. War funded more war. A self-reinforcing loop. But here's where it gets dangerous. Rome didn't rely on taxation alone. It relied heavily on borrowing. During long, expensive conflicts like the Punic Wars against Carthage, the Republic raised massive public loans from wealthy elites, especially the equites, Rome's rising financial class. These weren't simply patriotic donations. They were investments, and investors expected returns, interest payments, tax farming contracts, and privileged access to business opportunities in newly conquered territories. War became a pipeline for profit, and once profit becomes part of the incentive structure, the pressure for more doesn't disappear. It intensifies. Over time, this militarized economy reshaped everything. Political power tilted toward generals who could promise spoils. Senators became stakeholders in expansion. Private contractors, the publicani, handled everything from tax collection to supplies and logistics, skimming fortunes along the way. It was a kind of military-industrial capitalism in a toga, and the costs kept rising. To pay soldiers and creditors, the state needed fresh revenue constantly. When conquest slowed, or when revolts, disasters, or civil wars drained the treasury, Rome reached for the oldest trick in the book, debasing the currency. Starting under Emperor Nero, the silver content in the denarius was reduced. Over the next 2 centuries, emperors kept diluting it, turning what had once been a dependable silver coin into a thinner promise backed by shrinking metal. Inflation followed. Confidence eroded. By the 3rd century, Rome's monetary system was in freefall. Meanwhile, the rich insulated themselves. Senators and equites protected wealth through land, slaves, and overseas networks. Ordinary people paid taxes in harder conditions and spent debased coins in daily life, while elites secured exemptions, special deals, and insider advantages. Public services weakened, corruption spread, and the financial burden of endless war landed heavily on the lower classes through inflation, labor levies, and conscription. This wasn't only a military problem, it was a monetary one. Now pause and look around today. Governments run persistent deficits. Wars are often financed through borrowing. Central banks expand the money supply to stabilize systems under strain. A financial class profits through contracts, interest, and crisis-driven opportunities. And in many places, the cost shows up where it always does. Higher prices, weaker services, and growing instability for people with the least protection. It's not a perfect parallel, but the DNA is uncomfortably familiar. What Rome teaches is that an economy built on expansion, especially violent expansion, eventually hits a wall. You run out of land to seize, resources to extract, or enemies to defeat. And when that happens, the system turns inward. The debt remains, the expectations remain. But the easy revenue dries up. That's when the state starts squeezing its own people. Rome turned to heavier taxation, more debasement, more control, bread and circuses to keep the masses quiet while the elite fortified their villas. The labels change across time. The mechanics don't. Today we don't call it tribute. We call it taxation, quantitative easing, or monetary policy. But the underlying question is the same. Who lends, who earns, and who pays? The U.S. spent over $2 trillion on the war in Afghanistan, most of it funded by debt. Who gets the contracts? Who earns the interest? And who ultimately carries the cost through inflation pressures, reduced public capacity, and long-term fiscal strain? You already know the answer. And once debt becomes the default, you don't need a crisis to justify extraordinary measures. You just need to avoid collapse. Over time, the exceptional becomes normal, until it doesn't work anymore. That's what makes economic history worth studying. These aren't dusty stories. They're warning signs. When we look at Rome, we see a state that outsourced too much power to private finance, became dependent on expansion, hollowed out its currency, and strained its own citizens under unsustainable obligations, not because it was uniquely evil, but because the system didn't have a clean way to stop. Today we live inside a different kind of empire, digital, global, powered by capital flows instead of legions, but the pattern still rhymes. Money and power move together, war can still be profitable, inflation still hits the vulnerable hardest, and financial illusions still hold until they don't. So what can you do? Start by recognizing the pattern, because most people don't. Many treat inflation as random, debt as harmless, and growth as inevitable. The first step is clarity. You can't fully opt out of a system, but you can stop playing blindly. Study financial history, not just personal finance. Watch for systemic stress, not just market hype. Ask who profits when you stay confused, because you weren't supposed to ask how Rome paid for its wars, or how modern states pay for theirs. You were supposed to focus on the theater, the headlines, the slogans, the distractions, not the incentives, not the mechanisms. But once you see the machinery, you can't unsee it. Financial education isn't just budgets and investing. It's understanding power, understanding systems, and seeing through the illusion of permanent stability. So next time you hear about a new conflict, a new stimulus, a new emergency, don't just watch. Follow the money. Ask who lends, who earns, and who pays in the end. Because if history teaches us anything, it's this. Empires don't fall when the enemy breaches the gate. They fall when the math stops working, and no one dares to fix it. If this gave you a new perspective, hit subscribe. History has answers. I'll show you where to look.